Hello, everyone. What's going on? I hope everybody's doing well. This is Kevin Thompson of 99 Capital Group, and today we're going to take you through a quick quarterly update. No fluff, no headlines, just kind of breaking through the noise. We're going to be talking about interest rates, markets, what we're doing about it, and what to expect moving forward. So let's get into it. So let's start where everything flows, which is interest rates. Our base case is that Jerome Powell will not be cutting rates through the rest of his term. His term ends in May, and the market is starting to adjust to that. Now, could that change under the new Fed chair? Most likely, quite possibly. Kevin Warsh has been floated as someone who may be more amenable to rate cuts in the current administration's policy regime. But let's not be confused. The Fed chair does not operate in a vacuum. The committee actually matters. So, and historically, the chair and the committee don't diverge much. So even if leadership changes, policy doesn't just flip overnight. So our base case is we could see rate cuts during the summer meetings, but not because the Fed wants to stimulate the economy, but because they may be forced to respond to slowing conditions. Now, here's the bigger question no one's really asking right now. Do rate cuts actually improve employment? Factually, no, it doesn't. It has nothing to do with it because, again, they may create increased demand, yes, but that demand often leads to inflation, not sustainable job growth. And that's the balancing act the Fed is stuck in right now. You cut, demand rises, inflation risk. You hold, economy slows, labor weakens, especially right now where labor supply is starting to outpace available jobs. So they have a tricky dynamic at this present time. Outside of just interest rates, we have market expectations. So let's talk markets. We're not calling for anything extreme here. Base case, strong single-digit returns for the year. Nothing flashy, nothing dramatic. And honestly, that's a healthy market. Right now, markets are basically flat for the year. And this is actually why diversification matters, because while the U.S. may be a little bit choppy right now and or negative, global markets are still outperforming. And why is the case? Weaker dollar, better relative growth overseas, capital rotating outside the United States. So what are we doing about that? We're maintaining our overweight into international exposure, as you can see in most of your portfolios. We're keeping U.S. exposure slightly underweight, primarily due to dollar pressure. This isn't emotional, it's positioning. You go where the return drivers are. So now, if we're talking about return drivers, let's go to the commodities and currencies, right? Commodities, specifically gold and silver, sovereign nations and institutions are continuing to move into hard assets. Why? Because it reduces their dependence on the US dollar. And more importantly, it reduces exposure to control and sanctions tied to that currency. This isn't political, it's strategic. If you're a foreign government, holding gold gives you autonomy, reduces currency risk, and diversifies reserves. And we're seeing that trend continue. This isn't short-term trade. This is a structural shift, and we will continue to see that structural shift moving forward. In many of our client portfolios, we're holding those positions. We may be reducing a little bit of those due to the parabolic moves that we've been seeing, but we continue to hold those positions because we know that there's governments out there buying the metals. And of course, in regards to the military spending that's going on, the amount of silver being consumed to build these weapons is also in demand. So let's move to the fourth thing, which is employment and AI reality. Now, let's get into something that's being talked about, but not honestly. Jobs in AI. We do expect job losses to increase throughout the year, not because the economy is collapsing, but because companies are starting to evaluate cost versus productivity. Here's the issue. Everyone said AI would boost productivity, and it can, for sure, but companies are now looking at the CapEx spend required to implement it and asking, well, where's the return? Well, companies aren't necessarily asking that. Investors are asking that. They're asking, where's the return? Because right now, for many firms, the spend is real. The ROI is still unclear. So what happens? Companies cut costs elsewhere. Entry-level roles get squeezed, margins improve, but headcount shrinks. Meanwhile, companies further down the value chain benefit the most. They adopt the tools without massive upfront investment and capture those productivity gains. That's where you're seeing huge margin expansion. Now, outside of that, How about the portfolio positioning? So what are we actually doing with the portfolios? We're not chasing the headlines. We're reallocating with intention, moving cash out of money markets, reducing some fixed income exposure, allocating towards higher yielding opportunities. Why? Because sitting in cash worked for a long period of time. We were getting 4+%, but that window's starting to close. So it's being positioned out of being more feasible to be able to move assets into better risk-adjusted return metrics and not just parked in the cash. Now we may see, again, interest rates start to fall. When interest rates begin to fall, money markets become something that we don't want to be in, because the yields that we're receiving in those money markets aren't conducive to overall inflation-adjusted returns on that asset. Now, again, one thing I want to be clear on is just because money's sitting in money markets that does not justify the fact that they're not getting a return. The beauty about the money market is that gives us the flexibility to do a lot of different things, to put money into assets that we think are discounted, and to also give us that risk-adjusted return when we need money without having to sell off assets at a discount or a premium or what have you in the market, because we need those dollars. So it's important to understand that money in cash is not just about ROI. It's about functionality, reliability, and liquidity. Lastly, so I want to bring this all together. Rates are likely going to stay higher for longer, with possible cuts later in the year. Markets, we're expecting moderate returns, not extreme. Global exposure continues to matter. Commodities playing a bigger structural role, and employment likely softens as companies adjust to real productivity math. This is not a panic environment. It's a positioning environment. And the difference between these two, quite frankly, is discipline. If you have any questions about your portfolio positioning or what this means for you specifically, reach out. And as always, we'll keep you in mind, keep you informed, and keep you engaged, and hopefully keep you entertained. See you next quarter.